Ladies and gentlemen, welcome back. It is an honor and a pleasure for me to introduce our next keynote speaker, Dr. Claus Fischer. Dr. Fischer was born in Vienna in 1966. In 1993, he got his Doctor of Law from the University of Vienna. From 1993 until 2004, he was working as portfolio manager and strategist for the Austrian Central Bank. From 2004 until 2006, he was the executive director of the DZ, or the DZ Bank in Frankfurt, responsible for central bank sales. From 2006 until 2009, he was the managing director of HSBC, responsible for central bank sales. And from 2009 until 2010, he was the chief representative of the Austrian Central Bank in London, the financial attaché of the Austrian embassy as well. Since 2011, he's been the head of B2B business of Austrian Mint in Vienna. And the lecture that he's going to give us today is going to be talking, I believe, a little bit about also gold and also the gold market. So we're very much looking forward to the lecture and also having your perspectives from Austria as well as from the private sector. So if you could please join me in a very, very warm welcome for Dr. Claus Fischer. Thank you.
Thank you very much, the Institute, for having me here. I will speak about gold, and maybe let's just start how gold looks like. This is a piece of gold. And when it comes to gold, there are a couple of things I would like to discuss with you. Numbers and facts, gold supply, gold demand, gold holdings, and if we still have some time, about bars and coins, the most usual products in gold. But before I like to speak about gold, I would like to share a little secret with you. Everyone thinks there's a lot of gold in the world. I can clearly say no. If you take all the gold which was ever brought to the surface of the earth and you put it together in a cube, the length of the cube, one side would be 20 meters. So when you look at this whole institute, you can see here on the 2 floors, I think half of the world gold would fit here in these premises. So when we talk about gold, first thing we have to understand, it's a very special material. There's not a lot of gold in the world. This is what you can see when there's a certain demand in gold, that prices will react very, very quickly. So but when we talk about how much gold do we have, we talk about roughly 165 to 170,000 tons. Can we turn off this light again if possible? Thank you. But what can we do with gold? Gold is a very fine material. You can stretch 1 ounce of gold, 1 ounce is roughly 30 grams, into a length of 50 miles. Or in other meanings, it would be the length from Dubai to Abu Dhabi. You can, 1 ounce of gold, you can be hammered into 9 square meters of gold. So everyone who ever asks, how much gold do you need to gold plate a statue or you gold plate certain parts of the church? You don't need a lot of gold. Gold is a very flexible material. But one thing which is very, very important, and never forget, what is the overall holding of gold? It's 20 meters, cubic meters. 100 million people in the world depend directly or indirectly on gold and make their income. So where does all the gold comes from? This is again a picture from Hong Kong. There you see the cube of gold. It would also fit in 12 London buses. Maybe this also helps you to understand how little gold there is in the world. So where does all the gold go to? It goes to jewelry, private investment, official holdings, very, very important nowadays, and other fabrications, and only very little things we don't know where it really goes to. But it's overall 170,000 tons. Gold, you can only look at gold when you look at the price of gold. And the price of gold is measured in dollars since ever. And when you look at gold as a performance tool, as an asset, you will see that from 1981, and I took 1980 because it's just 30 years, it's a generation time span, had a huge performance starting at roughly $600 to nearly $2,000. But what you also have to understand is that maybe hopefully everyone can see it, that until 2003, so which is 23 years, there was no performance in gold. The only performance you could see was the underlying dollars. So if you looked at gold holdings, the gold price per se hardly moved. The only reaction you saw in your deposit was the reaction of the dollar. if you look at gold as a century-long investment, we know this, gold was not a very good investment. If you know this from the books of Julius Caesar, which is roughly 2,000 years old. 2,000 years ago, for 1 ounce of gold, you could get a servant and 2 cooks for 1 year, including 2 horses. So 1 ounce of gold is now $1,700 roughly. You could get the same people maybe for a weekend. So overall, if you look on a 2,000-year performance, gold was not a very, very good investment. Why did it get cheaper and cheaper? Because the sources to produce gold got more and more professional. Return on asset classes during periods of turmoil. It's very hard to read, but I would like to start with Gulf War I, LTCM crisis. Maybe some of you remember the first hedge fund crisis, dot-com crisis, 9/11, the 2002 recession, the Great Recession, and the sovereign debt crisis. So we had, going back maybe 20 years, we had 8, 9 crises, and we have a tendency to forget this crisis, and we have a tendency to forget how volatile certain assets are. And if you look at the certain columns, you can see that US equities are very, very volatile when it comes to certain crises. And you can also see, and not to go too much into details, that the only asset which has a positive return in crisis is gold. This is the golden color which you see on the top of it. So gold is obviously seen as a safe haven when it comes to crisis. I already explained that on a 30-year horizon, starting with 1981, gold was not always a prime investment, but the more you reach the new millennium, 2000, I'm sure every one of you can remember the great New Year's party, gold became quite a good asset class, but it was not only gold, also silver, and also oil. So you can say you have a commodity rally starting with the new millennium. And not only this, there's a tendency for everyone who follows the stock market that there is no performance overall in the stock market. And you can see the 2 low lines on the very bottom. It's the Dow Jones Index, and it's the S&P 500. And everyone who looks at CNN now and then and looks at the stock market, as far as I can remember, the Dow Jones is between 10,500 and 12,800. It really differs per season, but I can't remember seeing them below or above this number. When it comes to commodities, oil, silver, or gold, I remember 2002, the oil price was below $20 the barrel. Now we can see prices up to $140, $150. So there is obviously a commodity rally going on. I would like to add one more decade back. I would like to go to 1970. Starting with 1970, the chart shows you the performance of silver and the performance of gold, and how many silver ounces you have to give to purchase 1 ounce of gold. And it also shows that the commodity market in itself is not always going the same direction. In 1970, you needed 20 ounces of silver to purchase 1 ounce of gold. In the very highs of the 1991, you needed 5 times the amount of silver to purchase 1 ounce of gold. And now it goes back to roughly 50 ounces of silver to purchase 1 ounce of gold. And you guys are all aware, when you look at the newspapers, gold, there's always articles about gold. And 2, 3, 4 years ago, there was also the first article about the silver rally. And maybe some of you remember, silver used to be very, very cheap. It used to be like $3, $4, $5 the ounce. And suddenly, boom, it goes up to $50 the ounce. And of course, there is a huge possibility that there's speculation and not really supply and demand which leads to these prices. There's one very interesting for the older ones of you who can remember Ronald Reagan. Ronald Reagan was the president after Jimmy Carter, and he came in power in the late 70s. And there was the first really, really big silver speculation of two brothers. They were called the Brothers Hunt. They were one of the richest American. And they were the first really big commodities speculators. And they purchased silver from the mid-70s to the late 70s, and price rose until $50 the ounce, which was the highest silver price ever. Both brothers went bankrupt. JP Morgan got into huge problems because they were the bank helping and supporting them. And Ronald Reagan ended it with new legislations. Gold and equity volatility. Volatility is a measuring component. Volatility tells you how much risk you carry. The more volatility you have, the higher is your upward and the higher is your downward potential. And it shows that also gold, although seen as a very, very solid investment, as an investment, as we say, passed from generation to generation, it is a very volatile asset. And you can see every time when there's a volatility, the risk of the S&P 500 going up, you can also see at the same moment that the volatility of gold is going up. Of course, you have far lesser volatility, far lesser risk, but it's not protected, but it doesn't protect you totally against risk. This is the volatility, also the risk of different kind of asset classes, and it starts with emerging market equities. This is one of the biggest sellers of the last decades, the so-called BRIC, Brazil, Russia, India, China investment. Huge possibility of returns. That's the reason why you see commercials all over the world, but sometimes they forget to tell you, also very, very high risk. Commodities, of course, everyone knows it has risk. US small cap real estate, American real estate, everyone knows about real estate in America, can be very risky, very lucrative, but still risky. And you find gold right in the middle. Again, seen as 100% safe haven, but right in the middle of a risky asset. If you look to the other side, what is the least risky investment in the West, so-called Western world, financial world? It's US T-bills on 3 months basis. If you have 3 months T-bills, you will not make any money. Nowadays, you will lose every year a lot of money because of inflation and the low yields, but at least you have the less riskiest asset. And again, what do you have to do if somebody has a lot of gold and you want to immunize your risk? You go to the other end, you buy private equity. It's private US equity. Private US equities on the one side of the equation, gold would be on the other side. If you combine them with all the very important formulas, you have a very medium risk allocation. How much gold there is compared to government debt issues? That's also very interesting. You find the very rich European countries on the very left side, Finland, Norway, Sweden, Austria. I'm very happy to see them. They don't have a lot of debt issues outstanding. But starting with Portugal, Greece, and then UK, Germany, France, you see the overall debt issues. And you can nearly say all the gold which is in the world would equal the debt issues of France if you combine them together. CDS spreads, known as the nuclear bomb of financial services. The credit default spreads. I started in investments in 1993. I didn't even know what a CDS was until the CDS crisis came out. It's very interesting. You work in an industry, you don't know about the risk until they are here. It's very interesting. So CDS came on the table in 2008, and maybe some of you remember 2008 was the beginning of the American real estate subprime crisis. And suddenly CDS, which the originality of a CDS is the protection against a default of a sovereign debt. Normally you would say you don't need this. If you buy an Austrian bond, a German bond, you normally don't need any protection. There are other European countries, I don't want to say them, you all know which countries they could be. There is a tendency to be a little bit protected, but suddenly CDS spreads went through the roof. The very, very unpopular word pig was created. Portugal, Ireland, Greece, and Italy. These were the countries where CDS spreads, as we say in banking language, went through the roof. What you can see, gold has a steady line from 2005 to 2012, from $400 to $1,800, and they had a very solid performance before the CDS crisis, and they had a very solid performance after the CDS, or within the CDS crisis. And therefore, I think it's very short-sighted to say gold was a safe haven against the CDS crisis. I could show you, I don't have it with me, another graph which shows you inflation and the gold market. Interesting enough, during the period, and again, the ones who are a little bit older will remember in the 70s, sorry, wrong direction. In the 70s was the longest, was the highest inflation period in the Western European world. I remember in Austria we had inflation between 6 and 9%. But you can see the gold market hardly moved. You can see you can see it right here. So I think it's also very short-sighted to say the gold market only moves if there's high inflation. There can be a correlation, there can be an artificial correlation, but it doesn't necessarily mean there is a correlation between high inflation and the gold protection. Nowadays, and we have a member of the ECB here, former member, when I started to be in the central bank in the early 90s, there was the fight against inflation. It started, I would say, in the 90s. We had years of inflation below 2%, and still there was a great performance in gold. So I think it's a very short-sighted to say gold only performs in high inflation. So is gold overall a good asset? It depends. It depends where you live, and it depends when you bought it, and it depends in which currency you bought it. And that is my favorite chart. And we have a lot of different countries as a background, so maybe one of you finds him in one of the charts. We have the US dollar, the British pound, the Deutschmark euro, the Swiss franc, and Japanese yen. Just go back to 1972, and you bought gold, let's say 100 units, right here. And 30 years later, it's the performance of gold versus the local currency. And you can see not only that gold performed against any currency at all, it performs against the weakest currency within the 30 years. And no other currency had a bigger decline than the British pound. I remember stories from my parents when they said, I went to London in the 60s, I had 20 pounds. And they served me well for a week. Well, 20 pounds, I used to live in England, doesn't serve you for 2 hours now when you go in a nice pub. But if you changed back the amount of gold from 1972 back, you would have get 6,000 units back. So 100 pounds in 1972 would bring you now 6,500 pounds with the same purchase of gold. Which was the country with the most solid currency? It's no surprise. It is Germany and Switzerland. But when I say Germany, I mean the Euro region. So it includes all the other European countries. US dollar, again, a huge decline of the US dollar over the last 30 years. And then I like to take the gold out of the currency spectrum. Is gold a good asset class versus equities? And again, I think a lot of you cannot calculate too much on state pension. They have to go into private pension plans, and they have to think, what do I take? Do I take equity, fixed income, or commodities? just go back. In 1970, you needed, it's the S&P terms of ounces gold. So for 1 ounce of gold, you needed 2.5 ounces of gold to buy 1 unit of S&P in 1970. At the end of the Millennium Rally, you needed nearly 5.5 ounces of gold to buy the same unit. And with the decline of the stock market, you need less than an ounce now. So what does it tell you? Gold can be a good asset. It can be a good asset versus other asset classes, but the timing has to be right. So I have to speed it up a little bit now. Where does all the gold come from, and where does it go? Mining. This is the average global gold supply. Most of the gold comes from mining. It's fresh gold. A lot of gold, 10% of it, comes from net central bank sales. And recycling of gold is the second biggest source. It's nearly 2/3 of the fresh mining. This is where gold comes from, and you can see it's very unfairly distributed. In Africa, you only have Ghana and South Africa. You've got China as the biggest production of gold, and this also changed. China becomes number 1 in so many given ways, and also in gold it becomes number 1 before Canada and Australia. These are the biggest producing countries, and some of them you might be aware of. Some of them might be a surprise. Uzbekistan, Indonesia, Ghana, Peru was a surprise for me. So who owns all the gold? Not to a big surprise, gold is mostly invested in jewelry, technology, but as a second term, especially in the last couple of years, investments. And coming to jewelry, India, China, Middle East, Turkey, everyone who travels a lot, this is where all the big gold stores are. When you go to the souks in India, gold is part of the dowry business. All these goals are connected, all these countries are connected to gold over the last centuries. This is the gold demand per capita. And you can see that even rich countries like France have a very, very small gold demand. And countries, very rich countries, on average, like Saudi Arabia, have the highest gold demand, Turkey, Hong Kong. Germany is very interesting. That Germany, for an outsider, could be similar to France, but Germany has a very higher gold demand than France. Central banks, and this will be my last topic. Central banks own approximately 1/4 of all gold reserves. And when you look at them worldwide, America with 30% of the gold reserves. This is the Fort Knox story and the James Bond films. You can see these huge safes with all the gold in it. The Eurozone, with, of course, Germany and France as the biggest gold owners. And the IMF. IMF is a huge gold owner and one of the biggest gold sellers. Switzerland, China, Japan, and India are very small gold holders. When it comes to core Europe, as I said, France, Germany, Italy, they are the big gold owners. Where does gold go to? And this will be my final statement. If you look at the gold reserves of America, you can see that 80% of the gold reserves, of the reserves of America, are backed by gold. And why is that? Because they have a lot of gold, and gold got very, very expensive. This chart would be totally different if gold price would be still at $250. But now at $1,600, it's 70–80% of the gold reserves. And now look at China. China, as we all know, the central bank of China, the SAFE, has the biggest reserves in the world, mostly in US dollars. But it's only 2% of their central bank money is backed by gold. And just imagine the following scenario. Again, knowing that gold is just cubic meters, 20 cubic meters. If China suddenly starts to buy 1% more gold, meaning from 2 to 3%, by having an overall investment volume of $3.5 trillion, Just imagine how much gold this would be if they would keep it in physical cash. So is there gold upward potential? Yes. If institutional investors continue to buy, yes. If the government debt crisis in Europe continues, yes. When there's more turmoil in Europe to come, which we all hope which will not happen, but there is a huge potential for gold. So I would like to cut short here because we're running out of time. At 6 o'clock, I'm part of a round of discussion. So when anyone has questions, just because of the tight schedule, I would like to answer them at 6 o'clock. Thank you very much.